Yo, it's Titus. This is an important video, but do not get married to your stocks. Cut losers before they kill you and kill your profits. DCA is not a free pass for you to hold a stock forever. Sometimes the play changes and you need to pivot. And this is how. So disclaimer, everything said in this video is only for educational purposes. Make sure to always do your own research. But this is why you should listen to me. Midas will I beat the S&P 500 by 103x in less than a year. If you want the proof of all my calls, check on my YouTube description on my link tree. I'll show you the date of my calls, the takers I called, where the call was posted, whether it was YouTube or TikTok, and my total P&L, which is over 4,000%. If you want to take a look at all my stock and crypto picks, check out my link in the description. But let's get to the video. So my first point is don't get married to your stocks, be married to your thesis. And your thesis means the research that you did before even investing in any company. If the company fundamentally changes with new market, poor management, or bad strategy, your thesis is dead. That's your signal to cut the play and pivot your capital. And if you want to know if a company is going to die or a company has just become a loser, you can consider these points. The revenue and earnings consistently miss expectations. Usually what that means is that the company's not growing. They're not growing for the potential that what they're meant to do. That's definitely a red flag. And don't try to base it off of just one of these signs. You need to have a couple of these signs to understand that it's a loser or not a loser. Another point is management misses guidance or becomes secretive. Like if they're not trying to promote the company or not trying to, release their financials. I know Big Bay Area had a case like this, but it was all bullshit. So keep that in mind. A lot of these things what you might think is not true, could actually be true. But company pivots to a market with no competitive edge or clear path for profit. This is seen with a lot of Bitcoin miners where they go into more of AI data centers or whatever, and or go into the crypto space to become a Bitcoin miner, but they don't have any sort of Bitcoin development. That's usually just a rug pull. They're just there to just make money and or just make it seem like they're making money, but they aren't. So keep that in mind. If they do a huge pivot in their whole company fundamentals, like KULR ended up buying Bitcoin for their treasury, that's a pretty big change, and they're not really investing in R&D. So keep that in mind that usually when they try to pivot to a new edge, it's because the current edge wasn't working. So sometimes it might work. I think it might work out for KULR, but other companies probably won't. And cash burn increases without a plan to fix it. So keep in mind, they need to have a plan. They need to have some sort of revenue plan in order to increase their profit. And negative news stacking up with like lawsuits, scandals, product failures. If it's just a lawsuit with many small lawyer firms, like this happens to all tech companies. It happened with Big Bear AI, happened with SoundHound, happened with D-Wave. It's probably bullshit, but take a look deeper, look into the subreddit to understand if it's going to be legitimate or not. And stock breaks key technical support levels with heavy volume. I'm going to be making some videos onto the different indicators you should know if you're looking to get into trading. So stay tuned for that. But why continuing to DCA into a changed or failing company is dangerous. You're throwing good money after bad, aka throwing it in a hole. This kills portfolio returns and blocks your future opportunities. Keep in mind that everything in the stock market has an opportunity cost. If you buy one company, you're using the company to not buy something else. So the company you bought into, maybe it goes down 20%, and the other company that you would have gotten 60% increase. Keep that in mind when you're putting your money into these theses or into your research, because there's always an opportunity cost whenever you're investing in something. And this is how to pivot your capital. So either reallocate to companies with strong fundamentals, clear growth, and solid leadership. Look for asymmetric bets, not just cheap prices. Just because it's down 20% doesn't mean it won't be down another 40%. But don't hesitate to take small losses to fund your next winner. The whole point of the video is to not be married to your stock. So if you believe a stock just fundamentally changed, just take the loss and move on. Like, sure, maybe you'll break even in like 5 years down the road, but if you need the capital, move it to somewhere else because maybe that stock that you bought into with another pick goes up a lot quicker and returns a lot quicker than if you just held that stock for 5 years. Remember, there's always opportunity cost when you're putting your capital somewhere. And emotional investing is this sunk cost fallacy, where just because you hold a stock for months doesn't mean you should keep holding it. Cut losses early, protect your capital, because those are your defense. That's how you can grow your money faster and keep your portfolio nimble. The TLDR is that stocks are relationships, they're investments. When the story changes, so should your position. Learn to spot these leaders early, cut your losses decisively, and pivot to winners. That's how you build real wealth, not getting married to your portfolio. But if you have any questions, comment them down below and I'll respond when I can. If you want to take a look at my Discord community, I'm posting exclusive stock and crypto picks there. Check it out. It's on my YouTube description, on my link tree. But if you enjoyed the video, subscribe and like for more. I appreciate the support of all my followers. And that's all for today. I'll catch you guys in my next video. Peace.